While folks are joining, I'm going to kick this off because we're at the top of the hour. Welcome, everyone. This is our monthly SaaS conversations, and this month we're doing a Meet the Experts, and I'm incredibly pleased to introduce our expert this month. But with that, I want to get started with a few housekeeping things as people are still joining. So this is an interactive webinar. Please add any questions that you might have to chat or the Q&A. We will answer as we can throughout. We've gotten loads and loads of questions up front, and then you can always send us more questions after the webinar if something occurs to you. We're happy to take your questions. So let us know if there's anything you need, but with that, we're going to get started. So this is a Meet the Experts. We're going to focus on our special guest today, Kunal Mehta, an expert partner at Bain and Company, who is in the commercial excellence group at Bain. And we're going to be talking about KPIs and benchmarking in particularly around go-to-market, but just generally in the market today, because as we all know, 2021 is a bit crazy. So for those of you who don't know and are just joining us, my name's Kelley. I'm the CEO and founder of OPEXEngine, the largest database of SaaS operating metrics. We help SaaS leaders accelerate growth and improve cost management with benchmarks that they can't get anywhere else. And I have to say, I am so pleased to have Kunal with us today because honestly, Kunal, you're one of my favorite people at Bain. You just bring, you're smart, you're practical, and you just have such great operating experience, which I just love. So thank you for joining us today.
It's always a pleasure to be with the OPEX team.
So just a quick word about OPEXEngine. OPEXEngine was started by me 15 years ago. Have a great team of people working together. We have about 1,000 companies, primarily B2B software and SaaS companies in our community and our database. We've been honored to be able to work with about 70% of the US companies that have IPO'd in the SaaS sector to benchmark them along their journey and to help them get to such a great success and beyond. And we were acquired 2 years ago by Bain and Company, but we continue to operate as a independent company under Bain's umbrella. And as I mentioned, our focus is on B2B software and SaaS companies. About 70% of the companies that we benchmark are private, and actually now I think it's closer to 75%. So many public companies. I think about 20 public SaaS companies in the Bessemer NASDAQ Cloud Index have been taken private over the last year and a half or so, 2 years. And about 80% of the companies in our database are SaaS companies. We provide benchmarks for companies with revenues between $1 million and about $1 billion. So I thought I'd just establish kind of some guidelines or sort of baselines for the market that we're operating in today, because there's lots of different pieces of information out there, but Gartner still seems to be pretty happy about the SaaS market and says overall it's growing by almost 22%, which is one of the stronger sectors in the economy. And SaaS, if you see from the chart below, is still the biggest segment of that, although PaaS, cloud application infrastructure services, as well as system infrastructure services are the, sort of tying for second place. And at the same time, I was giving a presentation recently at a PE conference, and the head of America's Growth Capital mentioned something to the effect that there's about 50,000 investment transactions that have taken place over the past 2 years. And the reality is that not all 50,000 of those companies are going to survive and benefit from this growth market. it's a very different market than what it was in 2021, even though it was continuing to grow. There's just so many companies. And for companies to continue to grow, we really find that companies are finding success with benchmarking. So what we're seeing companies do this year is primarily focus on benchmarking growth and cost issues. And actually, just in our recent benchmarking, we've identified an average of 10% of revenue overspending against benchmarks. So I wanted to ask Kunal, why are you such a huge fan of benchmarking?
Well, thanks, Lauren, and just for the audience, real quick. But prior to joining Bain, I was actually an operator for 20 years, and that largely spanned across 3 areas: running RevOps. I was a CMO twice, and then I had a chance to be the general manager for a software infrastructure company that was ultimately acquired by PE. I later joined both that firm and another firm, and over a period of several years, I had a chance to work with 30 different companies on go-to-market value creation, which included a lot of performance benchmarking. So again, I had a chance to build the center of excellence for this PE firm, and the way our operating team was measured was with the magic number. The team had a portfolio of companies, and we would compare every portfolio company's magic number against a set of really carefully selected peers within the same industry. And the magic number, as you may already know, it gauges the efficiency of the go-to-market. It takes year-over-year growth, and you divide it by the amount spent on sales and marketing over the last 12 months. And for companies that were performing under a comparable peer set, we knew we had a problem, and we had a very prescriptive way of moving the needle. And then this very prescriptive way started tactically, but it generated so much ROI and so much lift. It ultimately funded the more transformational plays. But again, over a period, we were measured to move the magic number from where it was to certainly past the industry standard over a 2-year period. Why do I love performance benchmarking? It really comes down to, one, explaining with data why the value creation plan makes sense. And it got the investors, the management teams, and certainly the portfolio ops team on the same page very, very quickly.
Yeah, it's funny. That's one of the things that we hear very frequently from customers. They don't typically start working with us and subscribe just to get everybody on the management team on the same page, but that's what happens. And I think it's interesting. I was in a conversation this morning, and someone, I was mentioning that the company we were working with didn't have their, they weren't really tracking in any depth their customer metrics and their unit economics. And the first statement from this person was, 5 to 10% of the improvements that you'll see is just getting the right KPI, tracking and getting the management team all on the same page.
For sure.
What are beyond the magic number, which is really it's like a great sort of rule of thumb in terms of what's the health of your sales and marketing? Are you getting the kind of growth out of it that you're looking for? But then, okay, so what do? What are the metrics you look at underneath that to try and diagnose any, areas that you need to improve in go-to-market?
Yeah, it's a fantastic question. So when I talk about, and I think you explained it really well, Lauren, the magic number is like a thermometer, right? We know if we're out of, our comparables are operating better, we know we're sick, but then we need to unpack, to know where to focus our time and effort. And certainly we could look at things like the customer churn and the renewal rates. While it's very critical to acquire new customers, but retaining existing ones was equally critical. So if you have high churn, if your on-time renewal rates are low, it's vital to kind of start there. If I use Netflix as an example, where they have a margin of $50 per subscriber, originally years ago they had a churn rate of 10%. They were able to drop it to 5%, and that changed their customer lifetime value. It drove it up from $400 to $900. It did not matter at that point that the customer acquisition cost is $100 per subscriber. Reducing acquisition costs would have made a slight difference, but it's nothing certainly compared to reducing churn. Another area that you look at there is the company driving routine price increases, because even a modest increase year over year changes the margin not only changes the margin profile, but changes the CAC to LTV ratio. Then other areas we look at just is if I think about just go-to-market hygiene overall, out of the 30 companies we work with, 29 weren't able to prioritize accounts. So we ultimately built a propensity model that helped them focus on accounts with the highest propensity to either expand, if we look at their customer base, or the highest propensity to buy new. And then we built sales plays to canvas that opportunity in a much more efficient way with an integrated approach. Again, in 29 of those 30 companies, the wiring for marketing was broken. So we could, and there was lots of things that we would find across the portfolio. Lead dispositions, which is like, what happened to the lead? 40% of the time they never had a status. So the benchmarks, just by saying the magic number is off, you can really quickly dive into and figure out where to drive hygiene in the go-to-market, where to make quick fixes. I think those two things alone, propensity modeling and sales plays, drove the magic number across the portfolio of companies we were working with. It drove it up 8 cents. So again, I think those were good areas. And I think, Lauren, maybe you can provide an example of how go-to-market benchmarking has helped, SaaS companies identify growth opportunities and cost savings as well.
Yeah, and just responding to what you were talking about, I ran sales organizations for a number of years before I started OPEXEngine, and was responsible for revenue. And so one of the things that we have as a benchmark at OPEXEngine for companies that, again, like the magic number, but a level down, is something that should be easy enough to track and should be something that is consistent, it's quantifiable company by company. And that is looking at your, MQL to close rate, and then obviously benchmarking it based on your business model, because it's going to be different for big enterprise sales versus, small transactional sales. But it's just something quantifiable that can tell you whether your velocity and your, spending on lead gen versus, lead nurture is, higher or not so high. And then just sales cycles, being able to really make sure that you are measuring your sales cycles. And yeah, everybody's got different kinds of customers and different products, different markets, but it is really helpful. And if you can shave off 10% of your average sales cycle for free, in a sense, you're freeing up some sales resource. And if you can shave off a little bit on your MQL to close velocity, again, you're freeing up some of that money, or you're at least identifying some of the bottlenecks. And that's the kind of thing that I found, in my own companies was really effective, just to get people to focus on what you need to do. Because I think a lot of benchmarking is kind of seeing the forest for the trees. We all get so caught up in, like, one of the things that we've had success with companies is just at the highest level, all the people you have in the sales organization, and what is your expense, your comp in the sales organization. We love in sales to get really hung up on, and it's important work to figure out the right comp plans, the right salaries for different levels and different types of people. But at the end of the day, you're competing with other companies in terms of your cost basis and your performance. And so if you roll it all up, and maybe your average comp per person in sales is a little higher than the benchmark, it doesn't necessarily mean you have bad people or whatever. It might mean you just have a little bit too many people that are high paid versus you need more lower paid resources in sales. And it's, maybe you don't change that this year, but as you also plan on growing, you can see how those ratios between, for example, BDRs and account execs who tend to be quite a bit more expensive. And then the breakout between, how much is it costing you to renew versus pay people to go after new customers, those kind of things. We've just been able to help companies a lot with those kind of things, and just having it in front of everybody. And, it's just constantly iterating on, improving is really important.
Yeah, Lauren, you bring up so on the flip side, when we take an X-ray with performance benchmarks, the other thing that we look at, and I'm speaking with the private equity experience in mind, if we have 50 companies, there'll be companies that stand out that have just incredible strength, right? And in your MQL to SQL ratio, there was a case where this company was 10x better than the next best one. And then you try to figure out why. And then what we got to is that we figured out that they had this sales development process that where they were able to generate 500 dials a day, able to have 25 conversations a day, scheduling 1 to 2 meetings a day. They had a 30% close rate on these meetings. They were tracking everything from the average length of the call to follow up to they had all the wiring done. So what we ended up doing ultimately is codifying what this one incredible company was doing it. And it helped us install, that process in a lot more companies. And I think we took that one insight and we installed it in 10 different companies to get lift.
Yeah, no, I think it's, and that's, with so much investment going into this market and with the sophistication of investors and the focus on operating metrics. I mean, that's the one thing that we see this year. The last 2 years, investors were so focused on deal making and, deal sourcing and deal funding. And now the focus is really on, how do we build value in our portfolio? And, we can look at the, Vista's sort of famous for their playbooks, and they're not the only ones doing it now, and a lot of investors can help on that. But I just wanted to touch, you mentioned renewal rates, and I have kind of a pet peeve, or I wrote a blog about this, but I think the focus in the SaaS industry on net dollar retention got a little bit, out of whack over the past 2 years, with comparisons to Snowflake and 180% net dollar retention. And anytime, the first fundamental principle that I think everyone would agree on is that SaaS is a little more complicated model. It has many more inputs and drivers to success because, you have this virtuous chain of lead gen to closing new customers to account management and customer success and renewals and expansion within an account. And all along that chain, product and R&D and engagement have to be fully linked in. And then, you renew the customer and you bring in more customers, and the circle just keeps getting bigger and bigger. And that's why SaaS is such a valuable model. And on the focus on one metric always causes distortions. It's kind of like comp plans. I've done 1 million sales comp plans. And if you focus the salespeople on like one metric, they will go after, if they're good salespeople, they'll go after that one metric. So if the way companies are being valued in the SaaS space is on net dollar retention, companies will go after net dollar retention. Well, in times of disruption, that then can open you up, the tide goes out and you see some naked bodies out there because you don't necessarily know that big chunks of your sales organization are working with customers that are leaving, because if you were able to maintain, your expansion in certain areas, you're wasting sales and marketing in other areas that are not, retaining customers. So you have to look at your customer retention rate and look at whether, and certainly we saw in 2008, 2009, and also in some slowdowns, 2018, and then certainly 2020, companies really doubled down on segmenting and doing cohort analysis of their overall customer base to understand, like, where are the profitable customers, where are the customers that we can close quickly, and shifting resources over to the good customers. And then gross dollar retention rate is just a really easy way to see if either your customers are retracting or your sales organization doesn't have discipline around discounting. So both of those things are things that you want to stay on top of. I know.
Yeah, I was just gonna say, like, we threw out a lot of different metrics there, and when we as a team had to put these together on our own, and the goal, if you think of a old example, is like having a Bloomberg style terminal to look at go-to-market metrics across the portfolio along with comparables. And we were doing this before we knew OPEX existed. But we did it because we knew we'd have high ROI and it would drive a lot of time savings for us as a team, our investors, our portfolio ops. But I would say some of the things that were really hard when we were doing it on our own, Lauren, and I think you brought this up, is like just data consistency. The way people define KPIs might even just have the slightest nuance, and it makes it really hard to compare. I know I talked about magic number, but some people take year-over-year growth and divide it by the last 12 months, or some people take it and divide it by the previous 12 months. Some people take the last quarter and annualize it. I think one of the things that OPEX does that's super helpful is normalize that for you. And as we were doing this, getting enough of a data set, especially across private companies, was really, really hard. So, again, that's another reason why I wish we knew OPEX existed at the time. And then simply just making it simple for everyone to view where they stand. If you're, I know when I'm using Waze and it tells me I'm going to be at a certain destination, I'm always trying to beat it. It's just, so again, I think this process of exposing, the KPIs broadly is helpful in terms of motivating people to beat those.
Yeah, it cannot be understated that just having those numbers out there, it's like you look at your own numbers, but you don't, so many CFOs have said to me, I don't know if this is good, great, or like below average. And, certainly my sales organization tells me these are like awesome numbers.
Right.
And, it's just really, you definitely, in times like this, you want various sources of information. You want third-party validation. You want to understand that. I'm just thinking, in the interest of time, it's almost at the bottom of the hour, and we're going to try a 30-minute webinar instead of a 60-minute. So we've gotten loads of questions about, the differences between VC-backed and PE-backed companies. I'll just say really quickly on that one, certainly early stage VCs that are investing in seed stage or early stage, those are very different than PE-backed companies. On the other hand, I think beyond that, in the growth stage, VC and PE firms are kind of coming together and very much looking at, what are the metrics for scaling? What are the metrics for financial performance? And of course, what are the metrics around cash and cash management? So I think what we're also seeing is that companies are preparing for a wave of consolidation. Investors are definitely looking at that. We see, it's great for our business. We see buyers and sellers both using benchmarks. I think for the sellers, it's really useful because the analysis that's being done right now is just, deeper than it's ever been before, from my experience. Diligence that was taking, 2-3 months a year or two ago is now taking 6 or 9 months. And one of the things that we're seeing, which is really interesting, is investors are actually, measuring the ability of a management team to respond to requests for information and validate it in ways that never really happened before. And I think that's tough for a lot of companies. And so it can take a year or two in advance of thinking about M&A to get your ducks in a row. And that's part of what benchmarking helps you do, is also see, shoot, I can't benchmark this number because I don't collect it in my company. I mean, it's there, but I just don't have it. What are you seeing on the Bain side? Because Bain's certainly involved in a lot of this.
Well, I was just going to say, like you bring up, we just finished a diligence. Lauren, this is a large company that's getting carved out. And they were looking for renewal rates and on-time renewal rates. And it took 3 weeks to get the answer. And we still had a lot of questions. Ultimately, it resulted in a lower valuation for the same reason you said, the amount of time it took to get the information. Just raised a lot of red flags on how they were getting it. Are the systems intact, not intact? And there was, not a lot of things didn't tie. I think on the Bain side, we see, I think the most important operating metrics we certainly see are things that demonstrate the company's ability to attract and retain customers. Are we looking for indications of demand? We're looking for the total number of users, net new additions, any trends observed during customer acquisition and retention. I'd say just on the growth side. On the engagement side, how actively users are interacting with products, and that could be daily, monthly, active, average time spent per user, number of sessions per user. On the revenue side, it's certainly total revenue growth, average revenue per user, revenue growth by geo, by product, just to understand where, also trying to understand how much pricing power and growth potential there is. And then obviously on the loyalty side, which I know OPEX does a great job of tracking many of these, but on the loyalty side, it's certainly important to know NPS and how that stands vis-a-vis the competitors as well.
Yeah, that's a great list of metrics. And when you think about it, how detailed it is, that's why it takes 6 to 9 months. One of the questions that's not listed here, but we also just got is, as a private company, why should I look at public company numbers? And I think it's important to look at public company numbers if you are a growth company, because public markets are the most efficient markets out there. And so valuations and the weighting of different metrics in the public markets between growth and profitability and other, the size of the market, et cetera, is just more efficient than you find in private markets, but definitely the private markets follow the public markets. So it's important whether you're looking at, to IPO at some point in the next couple of years, or whether you're looking at M&A, or you're just looking to build a valuable growth company. It's important to look at that. I think we're just running out of time. I wanted to mention, these are some of the metrics that we benchmark for companies, starting sort of if you look across the top, kind of the highest level, and then some of the detail down below. These are the kind of things that we look at in our go-to-market X-ray, which we're happy to talk to anybody about. But I guess to wrap up, Kunal, can you help explain why, how can SaaS companies stay competitive when the investment climate and the technologies are changing so quickly, and, how benchmarking, gives them a faster time to market?
Yes, I guess just to break down a couple in a nutshell, like competitive analysis, it's vital to always compare yourself, like you would in any race. You're checking a bunch of things to see where you stand against the field. We talk about CAC to LTV. We talked about churn rate, revenue growth, adoption rate, Salesforce costs, staffing ratios. you're in what you just, put up there, you're almost getting an X-ray for weaknesses and strength. So again, I think performance improvement, we talk about ways, but making that very public and visible, because benchmarking is a very powerful way to drive continuous improvement. I think that's second. And third, which, for those of you that have financial sponsors, it drives a lot of investor confidence. It's a fast way for investors to really understand that, kind of where we're going to mobilize around value creation, and it also showcases how you can accelerate decision making, really, which is drives again a lot of investor confidence, and again, for a portfolio company, it certainly optimizes their team time because they can allocate those resources to the highest ROI efforts or the highest value creating efforts. So with that, Lauren, I think I'll turn over to you.
That's awesome. Thank you, Kunal. So just to wrap up and keep it within our time, for anyone who wants a recording of the webinar, it'll be sent out to everyone who registered. But just thank you, everyone, for all the great questions that we got in advance. Keep them coming. And if you want to see how your company stands against top performers in go-to-market or cost management, just drop me a line and I'm happy to talk to you about it. So thank you, everyone. Appreciate the time, and so many thanks to Kunal for participating here. Appreciate it.
Thank you all to all your great listeners, and thanks, Lauren, for hosting me.